Hello and welcome. Today on It's the Economy, we discuss an interesting report by Ashish Gupta, the CIO, Chief Investment Officer at Axis Mutual Fund. Ashish argues that although domestic mutual funds inflows have been continuing and rising, two factors are hurting or can hurt the markets. One, heavy selling by foreign funds, of course, in October, a little less so in November, and huge supply of shares, either because promoters are selling, PEs are selling, IPOs are raising money, or older companies are raising via QIPs. In fact, in the second half of the current year, that is starting October, the number of IPOs lined up are 3 times the number of IPOs in the first half, says Ashish, looking at draft filings. And so, of course, the question is, have we already seen the peaks for this fiscal year? Joining me, of course, is the author himself, Ashish Gupta. Good morning, Ashish. Thank you very much for your time and for a very interesting report. So your worry is that it is not FPI selling which is bringing down the market, but rather the excessive supply by IPOs and companies?
So, Latha, what we wanted to highlight with this report is that ever since 2020 post-COVID, the Indian market has had primarily move in one direction, despite whatever the direction of foreign flows have been. So if you go back and look at 2022 and 2023 financial year, you had actually, even in those years, FII selling coming into the market. And if I recollect correctly, in 2022, there was $18-19 billion of foreign selling, but the market actually continued its uptrend. And the reason for this has been that domestic flows, both through the mutual fund as well as direct retail investment, continue to be strong. But since April 2023, we actually have seen that the supply of equities and what you mentioned in the opening in forms of promoter selling, in form of IPOs and QIPs, has already been in excess of the flows into the funds. So really, the message we want to give to investors is that just because mutual fund flows continue to be strong, and last week the numbers of October were out, mutual fund inflows reached a new high of nearly 40,000 crores, with SIPs at 25,000 crores, you still had a downward momentum in the market. And the reason has been that in the past 18 months, nearly 40% of the supply of paper in form of IPOs and QIPs was actually being subscribed by foreign investors. Right? Okay. And so our expectation is that going forward, looking at the fact that this supply is so large, the direction of the market will be volatile and will also depend on the direction of foreign flows, not just what is happening on domestic flows.
Okay. So we can no longer rely that because we have an equity culture coming in, savers turning investors, that does not neutralize all the other negatives, is your point. Okay, let me take one by one of the negatives. The first, of course, is this huge FPI selling. See, even if you look at your October and November numbers, October, the sale was nearly $12 billion, 11.2 billion, if you look at the net number.
Yes.
But in November so far, the sell is more like 1.8 billion or thereabouts, 2 billion. So do you think that, the China factor hurt us a lot, but the Trump factor is not seen as so seriously, India negative? In fact, today CLSA has put out a report saying that they are reversing the sell India, buy China, and making it again sell China, buy India. So do you think the FPIs have a good chance of becoming neutral or even positive?
So I think the medium to longer term direction of FPI flows, I'm sure, towards India will continue to be positive. I think there's no two ways about it. India remains one of the few consistent structural growth stories. As we know, it's the fastest growing large economy in the world. So there is no reason to assume that the direction of foreign flows over the medium to long term will be negative. If anything, in the last 4 years, because FIIs have not invested significantly into India, even as India's weight in global and emerging market indices have gone up, they are already very underweight on India. So the medium to long term view is certainly positive. Of course, that does not mean that week to week or month to month you cannot see volatility in FII flows. And frankly, more than the China factor, I believe what was visible in October was outflows from emerging markets, also because the US bond yield went up nearly 75 basis points, right? And we had seen since end of last calendar year pick up in foreign inflows as US bond yields had moderated. So I think one of the biggest variables that will drive the direction of foreign flows will be really how the yield moves happen. If the higher for longer rate narrative starts to fade away, I'm sure you will see acceleration of foreign inflows.
Okay, so we have to look at the US yields very closely. Now, you are also speaking about the other negative for the market is the excessive amount of money that is being drawn by IPOs, QIPs, and promoter sales. Do you think that will peak off as the multiples become more normal? I mean, we are already about 10%. We are in correction terrain as far as the Nifty is concerned. We are 10.5 down. And mid caps, we are down nearly 12% from the September highs. So won't the sales by IPO and QIP guys lessen?
So certainly we have seen some correction, but again, if you see roughly the market is where it was in July, right? So I don't think the valuation correction has been massive to really drive a rethink in terms of people planning these stake sales or IPOs. In fact, the correction in multiples has been lesser than the drawdown in the market because in the past 1 month, earnings have also been downgraded. So if you look at the PE multiples, they have not contracted by 10 to 12%. I believe in the coming 6 months, really that is the time period we have visibility on supply. In addition to the IPOs and QIPs, even on stake sales, you will actually see a pickup because when there's an IPO, all the pre-IPO investors get logged in for the period of time. And given that even last year there was a big acceleration in IPOs compared to 2023, you will actually see more lock-in expiries happening and that supply coming to the market. So I believe at least over the next 6 months, the visibility we have is that there will be between in the second half of this year, somewhere between 3.5 to 4.5 lakh crores of primary plus secondary supply of equity.
Oh, that's a lot of money. And no mutual fund inflow is that big, even if it continues. But you also end your note on a positive note that probably the capex, private capex cycle is picking up. Are you confident that all the equity raising IPO plus QIP is leading to a private capex cycle?
Certainly, I think we are seeing in terms of IPO, again, the IPOs have two parts to it. Part of the IPO is also secondary stake, so offer for sale. But if we net that out, still over the last 18 months, about $25 billion of primary capital has been raised by corporate India. And we are seeing this being raised in sectors like power, real estate, autos, and these companies certainly have the investment plans. And again, you would have seen the order book numbers that many of the capital good companies have indicated. So we are continuing to see a positive momentum in private sector capex. Of course, even the government capex after the pre-election lull has started to pick up in the last 2-3 months. So we continue to be positive on the capex cycle.
Okay. I never have enough time with you. I have to pay attention to the debt and the banking sector as well. We saw this huge influx of FPI debt into India because of the index inclusion. That seems to have petered out. And now US yields have also risen. So two things. Do you think the yield rally is over? Now we are going to see Indian yields also kind of at higher levels. And therefore, does that make life easier for banks? Because they saw a lot of competition with people raising corporate CPs and, bonds. Now, do banks get a little more elbow room because there isn't so much competition from the bond market?
So I think for banks, the bigger challenge has not been in terms of the credit demand. I think in the last 12 months for banks, the challenge has been in terms of really the deposits and liquidity. And there as well, I think in the last few months, we have seen some easing in the liquidity environment. Of course, RBI has also moved to a neutral territory in terms of their stance on liquidity. And I think that is the most important really driver for bank in terms of growth, the amount of liquidity and amount of deposits that are available to them. I don't think in India we have a challenge in terms of really credit demand. As such, whatever slowdown we have seen in the last 9 months in bank credit is either because of lack of liquidity or because of regulatory actions.
So do you think the deposit craze is over? Are deposit rates peaked off?
So I think we have seen now deposit growth rate starting to match the loan growth rate. So both are around 11.5%. Unfortunately, this matching as of now has happened because of loan growth coming down rather than really deposit growth accelerating. I think what we need to see is that as the liquidity kind of sustains itself, can we see a pickup in credit growth as well as deposit growth? So I think we need to see that still to happen. I think the central bank actions will be quite important to watch in that regard.
Okay. Well, sorry, out of time, but it does look like banks have a slightly better investor sentiment with the bank Nifty at the moment being the only one that is in the green. HDFC Bank is something we should watch very closely. Well, I have to take your leave and a promise to have a more detailed discussion on another day. Thank you very much for joining us, Ashish Gupta. It's curtains also on Bazaar with the news that there is still a lot of pressure on both the mid caps and the big indexes. It's just the bank Nifty holding just head above water. Thanks much for watching.